In this video, we will be looking at the potential of an AI bubble happening in 2026. So what is the AI supply chain like? At the top, we have ASML that builds the EUV machines that enable advanced chip production. TSMC manufactures those chips for companies like Nvidia and AMD, which design AI GPUs and processors. Memory, packaging, networking, and cloud providers then support deployment, while AI models and applications bring the technology to end users. Together, they form the complete AI ecosystem. So it makes sense to say that as ASML and TSM being the top of supply chain, as long as the results are strong earnings each quarter, it suggests the AI boom is backed by real demand, even if the market become overvalued. And we can see here that ASML just beat the 2026 second quarter earnings, and so did TSM as well. So the AI ecosystem is still intact with strong demands and no bubble. So what are the AI stocks? We have the well-known Nvidia, Broadcom, TSM, Microsoft, Palantir, etc., etc. Let's have a look at Nvidia, Broadcom, and Palantir to see if they are very overvalued. The line drawn as the intrinsic value, the real value of the stocks. These three are not very overvalued, but somewhat overvalued and close to their intrinsic value instead. So what are the non-AI stocks? We have some of the best companies in the world that are considered non-AI stocks, like JP Morgan, Visa, MasterCard, Coca-Cola, and Pepsi. While investors have been chasing AI stocks, many quality non-AI businesses have been left behind. Some are still growing earnings and generating strong cash flow, yet trade below their intrinsic value like Pepsi and MasterCard. Why the AI bubble narrative? Reason 1, AI circular financing is where the money keeps circulating within the AI ecosystem. Investors fund AI companies spend money on chips and cloud infrastructure, suppliers report strong earnings, stock price rises, and more capital flows back into the ecosystem, thus creating the circular looping. Reason 2, AI infrastructure spending is estimated at around $400 billion, while enterprise AI revenue is closer to $100 billion. Bears argue this gap means companies are investing far more than AI is currently earning. If AI adoption and revenue don't grow fast enough to justify these massive investments, companies may reduce future spending, slowing demand for AI chips and infrastructure. Reason 3, around 30% of the S&P 500 is concentrated in just 5 companies, the highest level in decades. Bears argue that even if these companies are fundamentally strong, the index has become overly dependent on them. If 1 or 2 disappoint on earnings or AI growth, their large weighting could drag down the entire market, making the S&P 500 more fragile than it appears. The biggest difference between today and the dot-com bubble is valuation and profitability. During the 2000 peak, many technology companies traded at extreme valuations despite generating little or no earnings. Cisco, for example, reached roughly 472 PIGS forward earnings. Today, Nvidia trades around 24 to 26 PIGS forward earnings, a much lower multiple backed by strong profits. Another major difference is how AI investment is funded. In 2000, many internet companies relied heavily on debt, venture capital, or issuing new shares to finance growth. Today, hyperscalers like Microsoft, Alphabet, Meta, and Amazon fund much of their AI infrastructure using operating cash flow from profitable businesses. Fundamentally, it is much stronger than it was during the dot-com era, which investors today are paying for companies that already generate substantial cash flow rather than betting solely on future potential. My conclusion is that AI is real, but a bubble isn't here yet. As long as key supply chain leaders like TSMC and ASML continue growing revenue, it suggests AI demand remains healthy. I'll be watching for slowing revenue caused by weaker orders from companies like Nvidia, which could signal the cycle is turning. As AI is already improving productivity, it will become part of everyday life.